Welcome back, traders and investors. We have a very special guest here, Scott Hunsader, founder and CEO of Nanex LLC. Eric is very closely follows these high-frequency trading markets. Eric, how you doing today?
I'm good. Thanks for having me.
Thanks for coming on here, Eric. We've had some interesting markets here. We've had, obviously, since the flash crash of May 2010, we see these individual little flash crashes all the time, and you're always one of the first people to point these out. I follow you on Twitter there, Nanex LLC, and literally seconds usually after these happen, you're tweeting them out, and then you always have great reports on them afterwards. We had a number of them again last week, that one day where we saw Lorillard, AOL, NDAQ all lose 5-7% in a split second, and then these things immediately bounce back. Like I said, you're usually one of the first people to point these out. First of all, how do you find them so quickly? Because you're all over it. Like, what kind of tools?
It's software. I mean, when we find something that's quite regular, we just write an algorithm that'll detect it and then makes a little sound when it goes off.
So you have like a little flash crash alarm basically there at Nanex?
Yes, for this particular one, yes.
And then you just go and then you break it down, you look at what's happened exactly, and then you tweet it out.
Usually we ignore most of them. This one was interesting because they all happened at 15, 49, and 41 seconds exactly, and that's unusual. So,
how many of these, Eric? How many of these do you usually see? Like, how often are these happening? Is this a daily occurrence?
100 a day. 100 a day?
Yeah.
No.
Yeah. Yes.
So not like 5-10%, but you're talking like little intricate moves, or are you talking like a 3-4% move?
We're talking about ranges. It's we actually have on our site exactly the methodology for detecting them, but it's pretty significant. It will show up on a 1-minute chart as it'll look like a bad price tick, basically.
Now, what are your thoughts here? Like, why do these things continue to happen? Obviously, we put in circuit breakers here, which are supposed to help them from getting too extreme here, but it's just a market structure issue, is it?
Well, it's interesting. When they put the circuit breakers in, now these moves go right to the penny of the circuit breaker and turn around. It's almost like we've normalized this behavior.
Yeah, and that's the problem is obviously the circuit breakers are a Band-Aid where it doesn't get too extreme. If there's a circuit breaker, for instance, on a stock that's down 5%, the stock can still move down 5% in that split second and come right back, right? So it's still
right, exactly.
So
well, I think what happens is that you have some fast trading algorithms that detect a move like this in place, and they have a speed advantage, so they'll just pile on board, knowing that there'll be slower algos or humans or whatever running behind them that they can always dump off on.
So, do you think? Go ahead, Joel.
I was just going to say, so you think now that they have programmed the circuit breakers into older systems here, and so when the news hits, they have the levels, they can say, okay, we'll whack it down to X percentage, and then we're going to flip from offers to bids? Have they become that sophisticated?
Oh, yes, absolutely. Definitely.
But a lot of times these happen on no news at all. It's just a matter of sometimes lack of liquidity, isn't it there, Eric?
It is. It's like somebody coming in with a market order who, doesn't trade very often, didn't get the memo that market orders don't work like they used to.
Yeah, like I've been saying, market orders basically back on the floor. If you accidentally had a fat finger to send 100,000 shares back on the floor, the specialist, if you went back to the 90s or the early 2000s, would look at that order and say, does he really want to do that? Is this for real? Or he takes some time to put it together, and then you could quickly press the cancel button. You're like, oops, no, no, no. But when you press that button, go here and now, it's instantaneous execution. You're executed immediately. Isn't that more of the issue? Speed is good, but in this instance, speed is bad.
Right, and the other thing going on is Reg NMS only protects the top of the book. So, once they hit the 100 shares at all the exchanges that are bidding there, it's free to execute the balance locally. And so that's when Anadarko Petroleum went to a penny, for example, from $90, it was all at the NYSE. So if you didn't have any orders in at the NYSE, it didn't matter if you were bidding $40 at another exchange. They won't route to you.
So this is a little bit of a fragmentation issue too then, obviously.
Yes, I think, yes.
if you had all like like maybe the CME setup where all the trades are happening on the one exchange, all that liquidity would be accessible. So basically what you're saying is they protect the top of the book, but once it's all those trades are all executed, like it's SEC Rule 611, I believe, and once it goes through that though, then there's no more protection. So you could have somebody bidding potentially on like bats at a lower price that isn't protected, and that quote would get traded through. So you could be like somebody bidding at like $50, and it could actually trade through on the local exchange because of that quote not being protected, correct?
Exactly right.
Yeah. So, and the flash crash itself, do you have thoughts on that from like 2010, like the big one that happened? Like, was that similar events, or is this more just liquidity, or this was just
No,
a
that was
storm?
from the market makers hitting their full. So as soon as they got full, the most they are willing to take, which Kerlinko tells us was about 2,000 contracts, they just dumped it hard on the market. And I think they took advantage of knowing, hey, I'm going to dump these 2,000 E-minis. I might as well grab a bunch of options and short some stocks while I'm at it. And so what they did is they dampened volatility until they reached a breaking point, and then all of a sudden it's like they take 40 minutes of volatility and compress it all down to a millisecond. I mean, that when oil cratered about a year and a half ago, it was the same thing going on. You know, a fundamental seller was slowly feeding it out. The market maker was absorbing. As soon as the market maker got to their limit, they just dumped it hard and killed the market.
So Eric, you're I mean, I heard the general wisdom was that, the flash crash in 2010 was initiated by the S&P 500, but from what you're saying, you can kind of infer that someone knew they had the order and that they started whacking out other markets ahead of it. Then they put in this 2,000 share or 2,000 lot in the E-mini. So, I mean, from
I don't think they knew it. They just knew that they were full. So their algorithm would buy and sell and try to make a market until it got to a certain limit. And they absorbed 2,000 contracts, let's say. And as soon as it got to that limit, instead of trying to bleed that off and work that position down, the best course of action was to just dump the whole 2,000 at once. And they did that when the market was already in a pretty bad state, and we already had a flood of order messages, and that was the end. That's when there was lights out in all the quote systems and whatnot.
Yeah, you know what happened there too is like market making works well, and Joel and I both have market making backgrounds. It works well in a choppy market, an oscillating market, but when you get a hard trending market, and that day we were really trending down for a lot of the day, and I think I agree with your analysis there, Eric, because if you're a market maker, like picture this, Joel, if you're a market maker and all of a sudden you're getting full, well, you don't even have the affirmative obligations anymore like some of the market makers did back in the day to keep your bids out there. You're just full, and I'm getting out because I'm taking too much risk on this. And then obviously you also press that off button or that stop button and not even making markets anymore. And then you get like this whole vacuum area where there's no air, and you get so many stocks that traded down to a penny that day. Like the Accenture, I think, traded down to a penny. I think there was like 200 or 300 stocks, wasn't there, Eric, trading down all the way to like a penny?
Right. It's interesting. Those penny trades and odd trades like that didn't really happen until about a minute and a half after the E-mini halted for 5 seconds. In fact, they almost line up with when CNBC was screaming it's the end of the world. And by the way, CNBC's their data information that they were reading and talking about where the market was, they were over a full minute behind. So when they were saying we're down 1,000 points and it's complete capitulation, the market was already climbing back up, and it was at that point in time that we hit all the sub pennies. I think people just started hitting, threw in the towel and did market orders.
Going back to the 2010 and now what what's going on in the markets, we're having a series of mini flash crashes. 100 a day is very concerning to me. Are you seeing any correlations in today's markets that may make you have an uneasy feeling about something like this occurring again?
It definitely could happen again. You just have to have the right. Well, we all, in the marketplace, I've been watching the market since '85, and you always have these news events that really get a lot more people involved watching the markets when you get these big trending days. And we haven't had many of those big trending days. We're going to get another one, and some system's going to break, or some new circuit breaker thing software went in that doesn't work as intended. Where Barclays, chooses the wrong item in their drop down instead of marking on close
Right.
market. And, that was pretty amazing. Those large cap stocks all moving like that.
Yeah, all at the same time. And that's what you think it was that they accidentally marked it market instead of market on close. Like that's what people.
That's what I read. That's what Bloomberg said.
Yeah, that makes sense too when you think about it, because the way the market on close order works, it would interact with the end of day liquidity, and there's a lot of liquidity there. But a market order at 349, when you send 100,000 shares, it will knock out some levels on a lot of stocks.
It was $250 million worth of stock that traded in that 1 second. Up from a normal, you would expect maybe 10 million in that 1 second. You had 250. That was a big deal.
Huge money there lost probably. Somebody probably lost their job on that one. Eric, I just want to go into Michael Lewis. Obviously, has come out with some strong allegations here in his book Flash Boys. He's now went on 60 Minutes there. We all know a couple or 6-7 weeks ago and said the markets are rigged against the little guy. What is your opinion here? Are the markets really rigged?
Well, I sent him an email and I said, Michael, your choice of the word rigged was spot on. It is rigged. You have got these. Here's what we've learned from all of the news events, the news leaks over the last year, where you have UMISH being sold early, and then you had the FOMC getting squirreled out of Washington into the data centers on September 18th. When you have two pricing mechanisms, or in other words, when you've got a fast price and you have a slow price, that works really well if the slow price people don't know that they're actually getting it slow. And that's what's going on with the quote systems. Every single quote out of the consolidated is not real time, and you've got it's not all due to the consolidation process. What we've uncovered and learned is it's the exchanges sending to the SIP. For example, NASDAQ sends to the SIP for NYSE ARCA stocks. They send it 40 miles. And at the same time, they send it 1,000 feet to the direct feed customers. Well, the laws of physics tell you right flat out that there's no way they can send it 40 miles in the same amount of time as 1,000 feet. So, these guys are collecting a significant amount of money for the consolidated. In fact, the consolidated is 1/3 of NASDAQ's profits if you go look at their latest filings. And I think the SIP and the consolidated deserve a little bit better than that, at least to be treated equally as a direct feed customer.
Could you just that term that you used there? Could you just elaborate on that? The SIP.
The SIP is a consolidated quote, which is there's about 2.5 million people who pay roughly $500 million a year in exchange fees. It's the $1 a month for the non-pro and the 100 and change per month for the pro. And this is what a lot of dark pools, all retail orders are priced based on the SIP. Or whenever you see the word NBBL, the term NBBL, that is what the SIP calculates. And so when you've got direct feeds pricing it one way, and you have the consolidated pricing it a little later, and you've got all these things that are actually based on it, like midpoint match or pegged order or whatnot, you have an incentive now for causing a dislocation between those two prices.
Yeah, because if you're pricing your dark pool, like your retail orders, against an old quote, then those retail orders might not be getting the best price, correct?
Right.
So if it's a different price, then there's a potential for that opportunity to profit from that latency.
That's right. And I guarantee you that was discovered not long after this all started happening back in 2007.
So you've got 7 years of this going on, potentially.
Right.
Yeah, the lag of the quotes. And then when you were talking about retail pricing and off-exchange trading and stuff too, there's another concern that I've obviously been very opinionated about in the past, where you've got, payment for order flow arrangements and different things there happening where, off-exchange market makers can trade directly against these retail orders. And like you're saying, for instance, sometimes they're not even getting the best fill, but then you're not even considering that those limit order traders that are sitting out there, and that's where I argue all the time, is because I, come from that market making background. I know how valuable my limit order is to the market. I sit my limit order out there, and then they step ahead of my order when, execute at my price without even having to put any bids or offers out there on their own. Doesn't that disincentive liquidity?
Yes, it absolutely does. I think the SEC simply just needs to read Reg NMS again and decide whether they're going to enforce it or not, because they're not enforcing it right now. All of these things are addressed in Reg NMS, the whole sub-penny pricing issue that you just mentioned. You can't jump ahead of another order for an insignificant economic amount. When they're doing, jumping ahead by a full penny on a $50,000 Apple order, that's a non-economic amount.
Yeah.
Question coming out of the chat here, and just trying to get this to the plane of our users. Can we compete? Is it something they should worry about? And then just a specific question, a trader's looking at something on the Options House platform, and they see a bid and ask. Should they just set their price and put their limit out there and hope for a fill? Whether it's above or below, or if it's a bid, should they wait till it's offered there? What can the individual trader do, or is there anything they can do?
Well, I think one thing you can do is you can write to the SEC or write to your congressman. You probably should want to pay a lot more closer attention to what is working for you and what's not. Try different things and be scientific about it.
The other thing too, like that you've mentioned in the past, is how market orders are toxic. And I know we've had some Twitter conversations, and then we say, well, limit orders are kind of toxic too, because if you're sitting your limit order out there, like Turd Trader is saying, it's an interesting name. Turd Trader is saying there in the chat, they can use that limit order against you there too. So like your market order, they can kind of, really take advantage of. And now the limit order, they appear to be taking advantage of. What order type can we really use here?
Heads I win, tails you lose.
It makes it
right, exactly. There should be for all the order types they've created for the high frequency traders, you'd think there would be more than just those two for everybody else.
The one thing that we've done at our firm is try to, obviously Bright Trading here, we try to talk about extending our time horizon, not competing on that market making level. Do you see that as, I know that seems to help our traders, like when we don't try to compete by being market makers, we try to compete not in, milliseconds or seconds, but we try to go out to like minutes or hourly time frames, and it seems to help our traders. Do you think that's a way we could help too?
Definitely, because the machines aren't going to look that far out. It's too costly. It's too expensive. So, really, that's the way to be, is to try to push out a little bit in time. Just don't go sub-second. Go a little further out.
Dennis and I debate a lot about, I think a lot of this started when, we went from sixteenths to pennies, and I don't think I really minded going to the pennies that much, but when the sub-pennies started coming in, I think that really changed the game, because basically, from going from 16 places where stock can trade to 100, now there's literally thousands or millions of prices that they can trade within a dollar range. Do you think
But you can't, right?
But I can't. I know, Dennis.
Right.
He's agreeing with me. All right. So do you think the SEC is going to, in order to combat the high-frequency trading, do you think that they're going to maybe go back to, just everyone can only trade on pennies? Would that, or would it not eliminate some of the problems that we have?
Oh, it would definitely eliminate a whole class of problems. So, any time that the regulators can actually, enforce rules on the books is always a good thing. I'm also, all for the Wild West, no rules at all. The problem is when you've got rules that are wink, wink, nod, nod. I may or may not enforce them. Who can build a business on that? You need transparency is needed. If you got rules, either enforce them or get rid of them.
Okay. All right.
Okay. The last question here, Eric, before we let you go, is the SEC. They only have so many resources. If you were the SEC, where would you focus your efforts? Like, what's the number one issue that you'd like to see addressed here?
Well, I wrote a page on this and told them exactly what I thought they should do with their new Midas is they should compare the timestamps coming out of the SIP with the direct feeds. And I've done that, and it's eye-opening, and they should do it too, especially in light of the NYSE fine in 2012. So what the NYSE was fined for goes on all the time. And so this little exercise here is something that will let them see it for themselves.
Actually, one more question here out of the chat. So I lied. I said I was going to give you but one more question. Some brokerages are revealing their pay for order flow profits there. Do you think we need more disclosure there? JH3 is asking, or is retail just too disinterested and they don't understand those disclosures anyways?
I think if Amazon can tell me as much detail about my $20 order, where it is shipping-wise, I expect more from a stock order. So you should know exactly why you got executed, when you got executed. There's no excuse for not. It's all electronic. I mean, they should have all of this.
Wow. Strong words from Eric Hunsader, founder and CEO of Nanex LLC. Eric is scanning the tapes and the wires every day to point out high-frequency trading, flash crashes. Eric, thanks a lot for coming on the show, giving us your insight, and I certainly hope we can have you back on again.
Thank you.
Thanks a lot, Eric.
All right, take care. Bye.